Mahesh Patil, the CIO at Aditya Birla Sun Life AMC, joining us on the show. Mahesh, hi, good morning. Thank you so much for making time. That's exactly the first question. Your take on the market?
Yeah, good morning. So I think markets clearly have been taken a new high, but if you look back, right, it's around 18 months back when the market reached the earlier peak, right? So since then, okay, we have seen that a lot of things have changed. The earnings growth has been fairly strong. The valuations, okay, which were expensive at that point in time, right, around 18 months back when the earlier peak happened, okay, because of around 25% earnings growth, valuations are now slightly higher than the long-term average, but not too expensive. We've seen that on the domestic side, I think there were concerns about growth slowing down, even global growth concerns. Actually, growth has slightly surprised on the higher side. So I think while it looks like the market is at a new high, but we think that if we take a slightly one-year view from here, I think the earnings growth this year, for example, in FY24, should be around 16%. That's what we are looking at, even consensus around that level. So given that, I think the market can continue to scale highs. Obviously, there will be some correction pullbacks in the market depending on how the global cues are. Because I think one difference which I see the strength of the market is that the breadth of Indian market has been much, much better compared to the rally what we are seeing in the, say, the US market, S&P, which has been driven by a few handful of the stocks, right? If you remove those technology-led rally, it's not been at that great. Whereas in Indian markets, if you look at the number of stocks which have amongst the BSE 200, which have moved above the 200-day moving average, it's almost 70% of the stocks. So it's much more widespread. And it's spread across sectors, right? It's not just a few sectors. So that gives a lot more comfort that the rally should sustain.
Hi, morning, Mahesh, and wanted to also get in your thoughts on the entire IT sector because that's really borne the brunt of a pretty, choppy or worsened macroeconomic environment. You've also had the consistent rate hikes. What is the outlook on how you've seen a lot of these companies take on all of this news? And do you believe that one would need to be very selective when it comes to IT?
So the IT sector has underperformed last 1 year, one of the worst performing sectors, rightly so because of global growth concerns. And we've seen some downgrades to earnings growth, top line growth in the last quarter. I think at the end, by the end of this quarter, you might see another 3-4% downgrades to earnings. But I think that should be the bottom in terms of the downgrades because we have seen that while there has been some slowdown in the discretionary spend, there are some large ticket wins, okay, which are there, where companies are trying to really do cost takeout deals. And I think the overall spend on digital, okay, which has started during the COVID, I think will continue for the next 3-4 years. So we think that, this year, where you will see the growth slowing down, but I think post that, I think it should again crawl back a bit, not to the levels which was there a couple of years back, but definitely around, say, 10% or so. And I think with the correction in the IT stock and the valuations are now more reasonable. Companies are doing buybacks. The dividend yield is very good. So we see limited downside here in the IT sector. And within that, I think in this period, there'll be a lot more divergence in terms of how the company reports their earnings. I mean, there'll be few companies which will report around 13-14% top line growth. Others will report low single-digit growth. So I think it might be that companies which are doing good execution, I think they would continue to do well. So it could be a bit stock specific at this point in time, but overall in sector, we think it's a good time to start looking at it now in the next couple of 2-3 months could be a good time to really build exposure in the IT sector.
Okay, so that's about the IT sector, but I wanted to come back to the first point that we were discussing with respect to the markets. Now, given the fact that we are at least reaching towards those peak of the valuation range, what's the strategy that you would recommend at this point of time? Because I do remember you have a multi-asset, portfolio as well. So what's the recommended mix right now with respect to equities, debt, other assets?
So you're right. I think markets are fairly priced over here. So it's not like it is very attractive. But at the same time, the risk reward is still fairly reasonable for a long-term investor to come in at these levels. We think that the risk reward across asset classes between, say, equity, debt, is fairly well balanced at this point in time. So we have two funds. One is the Balanced Advantage Fund, where it's a dynamic asset allocation over there. And we have the multi-asset fund, which is across equity, debt, and precious metal, which is mainly gold. So there, our allocation to equity is near our median range, which we have. So in a multi-asset fund, that is around 65% into debt, around 13-14% into gold, and the balance into debt. And even in our Balanced Advantage Fund, okay, our asset allocation model is suggesting that the equity allocation should be closer to around, say, 50 to 55% in that range. So we are in the median range in terms of asset allocation, which shows that the risk reward in equity is fairly balanced. And I think that's what I think one should recommend investors also really to follow, that continue with the SIPs. Don't go aggressive at the market at this point in time, but again, continue with your STP SIPs, and any market correction or pullbacks can be a good level to increase the equity allocation, because the longer term trend looks to be on the up.
Mahesh, a lot of market experts as well that we've been speaking to are now, becoming a lot more open to the fact that there is potential in some of these new age tech companies, with them going in for a cleanup act, putting the focus on profitability and pulling up their socks, if you will. Do you as well see merit in individual names within this space, or perhaps some interesting IPOs that you'd like to highlight?
Yeah, so I think the new age technology companies have actually, a lot of these companies are now focusing on profitability. Earlier, it was the top line growth. And I think now with them getting listed, I think the listed market space is also looking at profitability, because that's how they would want to value these companies based on that. So I think given that, I think many of the companies where they're already kind of breaking even at the EBITDA level, or likely to do so in the near future, one can actually now value them based on a traditional matrix, not necessarily on a 2-year earnings, but over the next, say, 3 to 5 years earnings time frame. And I think some of these companies are growing much faster, okay, than the broader industry. So they will continue to be high growth companies. But yeah, so I think selectively, I think in the space, companies which are now established their leadership, right, where the competitive intensity is not much, because that's a worry in this space, because if the competitive intensity is heightened, then companies continue to burn money, and the road to profitability is unclear. So I think wherever these criteria are met, and where earnings, you can project the earnings over the next, say, 5 years and then discount that, and you see value, I think those are the companies which we are looking at in the new age technology space.
All right. Thanks so much then, Mahesh, for joining in, giving us a view on the overall market outlook. So that's the take really coming in. There is room for more upside on the Lal Street, and we are looking at a fairly balanced risk-reward ratio down the line.